So let's run through some estate planning considerations. One of the things is, as we're getting into the election year, we've been already kind of, not, I guess, warning clients that 2025 is going to need to be an estate planning heavy. We're going to have an estate planning heavy conversation. There will likely be, we're going to need to meet with your attorney to make sure that your existing trusts is relevant, still works based on your net worth. So, we've kind of hesitated. We don't like to always wait till the year before the changes, but we're also fearful that if they make some big changes in Congress, then we don't want to waste our energy in 2024, based on changes that might be occurring in 2026. The other thing you want to be mindful of is, in California, we currently don't have any state death taxes. But in other states they do, like the state of Washington. So that's something that you want to be mindful of. Some things as well, we see a lot of family members will gift assets to their children. And you have to be careful there if you have what's called low cost basis property. There's some real downside of doing that. So, one of the things that we really encourage our clients to do is get your team together, and that would be your advisor, which hopefully is us, and your estate planning attorney, and make sure you're making good, well thought out decisions. Because we have seen over the last 10 years where somebody made what they thought was a good decision, but in hindsight, it was a poor one because they gave away assets, parents passed away, and it really messed up the estate, and it cost them hundreds of thousands of dollars, which we want to avoid. The second to last bullet point here says high net worth families may want to consider a gifting strategy for the additional lifetime exclusion amount. So I'm going to explain a little bit of what that means. But again, the last note on here is we're going to need to work with your estate planning professional dealing with the potential sunset of the law in 2026. So here's a graphical interpretation of where the estate exemption is going. So in 2023, the exemption amount was $13 million per individual, and it's expected to go in 2026 down to $7 million. So that means there's this $6 million additional gift exclusion that you could give away during your lifetime. Now, you wouldn't want to give it away if you needed that money to live off of, but by giving it away, if this sunset occurs and the rates drop down, the exclusion drops down to 7 million, and your estate potentially would save over $2 million of estate tax because of this. So there's definitely a big opportunity here for larger estates. It can get challenging when you're talking about giving away portfolio assets. You can't give away IRAs, real estate assets. So this is not an easy decision, but it's one that should be on your radar, because estate planning attorneys are going to be busy. So again, once we know the result of the election, it'll probably be time to start planning. There's also something that they put in place for retirement accounts. So the idea of a stretch provision is no longer valid anymore. So what that used to mean is that if you left your IRA to your child, they could basically take equal payments or a series of, they could stretch out payments over their lifetime based on their life expectancy. Well, now that provision is gone. Now, spouses can still stretch these out, meaning they can still take it out over their lifetime, but children and other beneficiaries cannot. So the reason why this is relevant is there's now a 10-year rule. So in my example on a prior page, I showed on the Roth conversion page where what if your IRA grew to $9 million and you had one child that inherited that? They'd be responsible for taking that $9 million out over 10 years. So you can imagine that would result in a really large tax liability. So a couple of just things to keep in mind. This is another great example as you're building assets. Is like, does it make sense to do Roth conversions, right, when the account owner is living, so that you can limit this exposure to the estate later? And then also planning if you are a beneficiary of, so like we have clients who've been beneficiaries of IRAs, and we're trying to help them plan. Like if they're still working, the idea of taking money out of their IRA, they don't love it because they got to pay taxes at a much higher rate. So then we're putting together plans of say, okay, well, let's maybe not take any money out the first 5 years, knowing that we'll have to take money out the last 5 years. So being thoughtful about this is really, really important. There's also an advanced strategy that maybe you consider is you could leave your IRA to a charitable remainder trust. There can be some tax advantages around that. That's a good conversation with your tax professional, with us, with your estate planning attorney, especially if you're charitably inclined. And we all know that most people focus on estate planning around the taxes, but estate planning is more than just the tax liability. Again, it's with your wills, your beneficiary designations. It's really critical to review and update periodically. So making sure your documents are still relevant. I just have, 2 daughters that are off in college and they're no longer minors. And so oftentimes, a lot of older trusts were built to accommodate minor children and having guardianship in there, and just different people involved with your trust. Once your children become adults is one thing. Once they become responsible adults is another. And that's where you might want to make some changes in your estate planning documents. But these are the things you want to be updating: your living trust, your healthcare and medical directives, power of attorney, things like that. These are things that you should be looking at every 3 to 5 years or so. That's kind of what a typical estate planning attorney will recommend. But especially if you have some of these life-changing events that are coming, and then again, if your estate's large enough, being prepared for that is going to be a must. So it will be a must do for 2025. So closing thoughts on this sections again. So, the reality is we have been living through a pretty favorable tax policy, and we're likely going to have some higher taxes in the future, depending on what tax bracket you fall in. So we're big proponents of trying to get ahead of that and be thoughtful about planning strategies. And then I already just kind of wrapped up on, when you're working with professionals, really understand your income and estate tax planning strategies. That's where we come into the picture, is really help from the planning perspective, because we truly feel we're in a unique setup. We know your financial goals. We've mapped out your cash flow needs. And so we're a great resource to work with these other professionals, because we really understand what your financial goals, and we understand the nuts and bolts, and we understand all the numbers when it comes to your financial plan. And so being thoughtful about this is critically important. So hopefully this was helpful. So a couple quick things, because I'm gonna do like a little bit of a natural stop here. So if any of you are prospective clients, we kind of have 2 options. If you want to connect with us, we can take you through our new client process, where we'll do a discovery and clarity meeting, where we'll just basically kind of walk you through and help you build out a financial plan and see if we can be of assistance, kind of give you a second opinion on what you're currently doing. That's option 1. That's a little bit more thorough of an option. If you just want to have kind of a tax return review, we have a tax software that we can help out with. We can review it, things like making sure you're not missing deductions and you're making smart decisions. So that's really, if you want to reach out to our firm, those would be the 2 approaches that I would take.